Welcome to the deep dive. We're here to sift through stacks of information, pull out the key insights, and basically give you a shortcut to being well informed. Today, we're going to unpack the latest Q2 report from JP Morgan Chase. Our mission really is to extract the crucial takeaways from the sources you've provided. We want to see what this financial giant's performance tells us, not just about its own health, but also about the wider economic picture. Now, something that immediately caught my eye looking at our sources was this subtle but I think pretty significant shift in CEO Jamie Dimon's comments. I mean, he's famous for that cautious tone, right? Always talking about dark clouds on the horizon. But the report suggests his remarks have turned, well, seemingly more positive, citing resilience now in the U.S. economy. This feels like more than just words. It could signal something bigger. So, okay, let's unpack this. What does this shift in tone really tell us about how we should view the economy right now?
Yeah, it's fascinating because, while the tone has definitely shifted towards resilience, the underlying message is still, balanced. It's nuanced. He's absolutely still pointing out significant risks. You've got tariffs, trade uncertainty, worsening geopolitical stuff, high deficits, asset prices looking elevated.
Yeah.
Those are all still there. But, and this is the key shift, he's now explicitly mentioning positives too. Things like the finalization of tax reform, potential deregulation. He sees those as helpful for the outlook. So the takeaway really is that, yeah, risks are still very much present, but the business itself is healthy. The outlook is looking more positive, and there's this sense that potential economic tailwinds have picked up.
Okay, that makes perfect sense. So not a complete U-turn, more like a recalibration of the
Yeah.
view. Right. So with that context, how did these comments actually line up with JP Morgan's Q2 performance itself? Our sources mentioned a double beat. That sounds good. That affirmed the stock price outlook, apparently. This is where it gets really interesting, I think. Can you walk us through the core numbers? What drove that positive assessment?
Absolutely. So yeah, the double beat, that just means they beat analyst expectations on both revenue and earnings per share. It's a strong signal. They did report a contraction in year-over-year revenue, which was expected, but crucially, it was less severe than analysts had feared. And when you look closer, you see clear strengths in really critical areas. System-wide, average loans were up 5%. That shows good demand. And deposits, up 6%. Even in community banking, which, had maybe some expected weakness, deposits only dipped by 1%. Tiny. And that small dip was more than offset by a double-digit jump in invested assets in that same segment. So strength there, too.
Okay, loans and deposits holding up well. What about the actual profit drivers?
Right, looking at the income streams, their net interest income, NII, that's basically the core banking profit engine, right? The difference between loan interest earned and deposit interest paid. That NII increased by 2%. Solid. Now, this was offset somewhat by a 20% decline in fee-based revenue, but the margins were solid overall. And that strong NII really helped the bottom line outperform. They reported $4.96 in adjusted earnings per share. Now, okay, that adjusted figure did include a $1.28 tax benefit. You have to note that. But even taking that out, they still beat the consensus estimate by a good margin. And because of this strong showing, they actually raised their guidance for the rest of the year. They're expecting better top and bottom line results than previously forecast, largely thanks to, you guessed it, robust NII.
Right, NII keeps coming up. It's clearly a huge driver here. So what does this performance tell us about the company's outlook on interest rates and how that feeds back into NII going forward? You mentioned NII is likely to stay strong through 2026. What's the thinking there? What kind of rate outlook supports that projection?
Well, this brings up a really crucial point about the whole macro environment. NII is projected strong through 2026, yes, because the report cites a, quote, favorable interest rate outlook. But here's where it gets a bit complicated, maybe, for you listening. The Fed, the FOMC, they want to cut rates. They've signaled that. However, our sources really highlight the problem. Inflation just isn't cooperating. It's proving sticky. In fact, the latest CPI numbers actually show inflation accelerating, both the main number and the core figure, compared to last month and last year.
Accelerating. Wow. Okay, that's the opposite of what you'd need for rate cuts.
Exactly. It directly contradicts the idea of quick rate reductions. So if you look at the CME FedWatch tool around mid-July, it was showing less than a 70% chance of even two small 25 basis point cuts by the end of this year.
Less than 70% for two cuts, yeah.
So you've got this real tension. The Fed wants to cut, but the inflation data is pushing back hard. And that tension is key to understanding why NII might stay stronger for longer than maybe some people expected.
That Fed versus inflation dynamic is definitely one to watch closely. Okay, so earnings look good, driven by NII. But what about the foundation, the balance sheet? Our sources call it a fortress. What do the figures tell us about that underlying strength and capital returns to shareholders?
Yeah, Fortress seems appropriate when you look at the numbers. Their financial position is just incredibly robust. You look at cash flow, the balance sheet. They've got substantial credit reserves built in, consistent with previous quarters, too. Same goes for charge-offs. That's loans they write off. The levels are stable, suggesting good risk management. And their capital ratios.
Good.
Excellent. The Tier 1 ratio, which is a key measure of that financial cushion against losses,
Right.
came in at 15%. Now, that was actually slightly below what some analysts forecast, but it's still way, way above the regulatory requirements. Very strong.
The 15% is definitely a solid buffer.
Absolutely. And then you look at shareholder returns. Also strong. Book value per share was up 10%. That's a good sign of underlying value growth. Plus, they authorized another $7 billion in share repurchases. That's almost 1% of their market cap. Provides a nice tailwind for the stock price. And on top of that, the board hiked the dividend again, second time this year.
Second time. Okay.
Yeah. The total increase now is 20% cumulatively this year. That works out to nearly a 2% annualized return just from the dividend. And they expect more increases down the line.
So strong earnings, strong balance sheet, and returning a lot of cash to shareholders. Seems like a solid story internally. But it's not just about the internal numbers, is it? It's also how the market sees them. How are the analysts, the big institutional investors, reacting to all this? Are they buying it?
Well, if you connect all those internal strengths to the bigger picture, yes, the market sentiment looks very positive too, both analysts and institutions. MarketBeat did track a few analysts lowering their price targets during Q2, sure, but those were more than balanced out by upgrades and increases to price targets before the quarter ended. So the net result was, when this report dropped, you had solid coverage, 22 analysts, sentiment was firming up nicely, and the average price target was trending higher.
Okay, so analysts are generally positive. What does that translate to in terms of potential upside?
The consensus target indicates about a 13% upside from where the stock was trading just before the earnings release. And analysts think that could be achievable, maybe before the end of 2025.
13% upside potential. And what about the big players, the institutions? Are they putting their money where their mouth is?
They are. Institutional activity lines up perfectly with this positive trend. They own over 70% of JP Morgan's stock, which is huge. And the data shows they were net buyers throughout 2025, buying more than they were selling, on balance. So having these major players, the big funds, collectively voting with their dollars like that, it's a pretty strong signal about the company's trajectory. It really underscores the market's confidence.
Wow. Okay. What a deep dive that was. Really illuminating. We started with Jamie Dimon's tone, that subtle shift towards cautious optimism, maybe. Then we went through the really impressive Q2 numbers, dug into that critical NII story and the fascinating push and pull between the Fed's plans and stubborn inflation. And we wrapped up looking at that rock solid Fortress balance sheet and the very positive vibes from analysts and big investors. It seems pretty clear that JP Morgan Chase is navigating these somewhat tricky economic waters with real resilience and a clear strategy, even while they acknowledge those ongoing risks. So thinking about this for you, the listener, as you look at the broader economy, what does this case study tell us? We've seen this powerful example, right? A major financial institution showing real health and strategic strength. But given those conflicting signals we talked about, the resilience mixed with ongoing risks, the Fed wanting one thing while inflation does another, how might these dynamics play out for other big banks? And maybe more importantly, what does this specific example, JP Morgan's strength, suggest about the overall stability of the financial system in the months ahead? Something to think about.